Hey y'all, Zach McDonald, your real estate agent with Real Property Associates, and the real estate market in Seattle is certainly shifting. And the question for today is, should I buy now or should I wait? You can probably imagine this is a question I'm getting a ton right now, and I've made a few videos here recently. My monthly market update, I talked about this a little bit, and I'll continue to talk about this in the coming months. I also made a video recently where I shared 4 reasons why I don't think that the housing market is going to crash in epic proportions like it did back in 2008 to 12 in the Seattle area. But in this video, we're going to talk about a little bit of what's going on here, and we are going to talk about why you might think about buying now and why it might make sense to hold off depending on your situation. So you've probably heard things like buy high, sell low. Just kidding. No, the historical recommendation would be to buy low and sell high, right? If you can time the market, that's absolutely amazing. But I think, as we all know, nobody has a crystal ball. There are certainly signs that we can look at and trends that we can look at, but I'm no prophet. I don't have all the answers. I don't have a crystal ball. So before we go through this video, we just need to know that and admit that nobody really knows 100% what's going to happen. Nobody predicted that COVID was going to happen and we were going to have a massive drop in the stock market and then we were going to have the quickest recovery we've ever had, right? That's not stuff that we can see. Now we can see things like, oh, we've spent a massive amount of money and dumped a bunch of money into the economy and inflation's taking off and we don't have enough of the goods that we need. And oh my gosh, now everything's getting really expensive and we're trying to slow down the economy, right? Which is what's happening right now, which is why we're seeing some of the things we're seeing in the stock market and now we're starting to see in the housing market. So I think the idea of buying low, selling high is amazing if we can time it perfectly. Obviously, we can't. So there's other things that you've probably heard like dollar cost averaging, which is where you're buying into the market every single month and you're buying the same things and you're buying them when they're higher, buying them when they're lower. It would be like if you filled up your gas tank every single week and some weeks it's a little bit more, some weeks it's a little bit less. That's actually what we do. Dollar cost averaging our gas prices, right? Sometimes we're like, oh my gosh, gas is a little bit cheaper. Other times we're like, ouch, that one hurt, right? But if you wait and you buy it maybe every 2 weeks, then you might always have those higher prices. So we're able to take advantage of those little dips. I also do buy in when there are opportunities. So you're always buying every month, but then you can buy in when there's dips. So for me, that might be a 5 to 10% dip of something that I already have and like. I'm going to buy some more of it, right? So the stock market's super volatile. And right now, the S&P 500 index is down 23.4% as of the 17th of June from its high the 3rd of January, which is a massive dip in the collective 500 best stocks, right? So I think the stock market's seen a pretty big pullback here, and that has affected a lot of people's money, right? We've been seeing massive jumps and now pretty much seen all of last year's growth just wiped away that quickly. So I think a lot of people's stock portfolios are down considerably, and now we're starting to see the mortgage rates jump, okay, significantly. So, right, the stock market's down more than 20%. That's epic. That's a big, big drop, right? So I'm actually buying more. This is the time, right? This is a time where you want to be putting money in. Of course, we don't know when that's going to stop. We don't know where the bottom is yet. I think a lot of people are speculating about that. And they think that the bottom's still not here. Other people think, well, we're going to have a big bounce here into the rest of the year and we're going to end at an all-time high. I don't really know, and I'm not going to pretend to know. And I think the same goes for the housing market. I think the housing market moves really slow, right? So the stock market's like, oh, it's like jumping 4%, dropping 6%. It's all over the place. The housing market doesn't move like that. It just takes too long for the process to happen. But mortgage rates are up. So if we look at Freddie Mac's data and they pull their survey every single week, as of June 16th, 5.78% with almost a point of fees, 1% in fees. I was hearing towards the end of last week that in a lot of cases we're seeing a couple points in fees. If we're looking at daily rates, mortgage rate daily. We've got their report, and as of today, which is June 20th, rates were at 6.03 according to their survey. And the weekly rates on bank rate as of last week, 5.91%. Okay, so we're right in that 6% range for mortgages. And Freddie Mac has their year-over-year comparison. Last year, rates were 2.85% less than they are right now. They've almost doubled from last year, which means that people's affordability has significantly gone down. So imagine somebody maybe thinking about buying their next house, that luxury purchase. Maybe they already own a house that they like, and they've got let's say they have a 3 to 3.5% interest rate because they refinanced when rates were good. And now they're looking at buying that next house. They can't stretch as far, so maybe there's not as much of a difference, right? And they also are going to have a significantly bigger payment and larger mortgage. So I think there's a lot of people thinking, I'm going to hold off, right? And we're starting to see that. I think we're also starting to see a lot of fear in the market, right? We're seeing fear in the stock market. I don't want to put money in. That's why the market's going down, because people are pulling money out, right? They're selling. You're losing money when you sell. Same thing with real estate. People are starting to feel fear. And that's causing them, again, there's that actual financial part, and then there's the part where they're like, maybe I'm going to sit and watch and see what happens and try to time this a little bit. And I think for me, I'm already buying into the stock market. I know it might go down more, but I don't know where that bottom is. I think the same thing we're going to talk about here as we get towards the end of this video is we don't know what's going to happen in the real estate market, but we do know it's already starting to slow down. People are already reducing their prices, and houses are already selling significantly less than they were with the multiple offers earlier in the year. So there's a buying opportunity, but more on that as we get towards the end of the video. If we look at historical mortgage rates, I think this is important. Historical mortgage rates. Recently, somebody commented on one of my videos and said, mortgage rates are at an all-time high. And I had to point out that that's wrong. All right? I think it's really important that we're getting our information from credible sources. And so if we're looking at Freddie Mac's data, right, they're doing these weekly surveys, and they've been doing these since the 70s. All right? Average rates since 1971, and this was put together by the mortgagereports.com. They have a sweet graph here, and I'm going to show this. I could easily have pulled this same data, right? They just already made the graph. It's all publicly available, and you can export it. But if you look at their data, you have mortgage rates up near 20%. 20% in the 70s, end of the 70s and into the 80s. You've got 15, 14, 16 huge interest rates. All right, now they've definitely trended down, but you have over 7% rates in the 90s, and they're slowly declining. But we had rates right around where we're at, 6%. We had rates over 6% in the early to mid 2000s. So it's not like we've never seen these interest rates before, but if you've gotten used to seeing 2.5%, 3%, 3.5%, 4% rates, you're thinking, wow, these are amazing. But historically speaking, these rates are not the normal rates. These are really, really low rates. So historically speaking, a 6% rate is still below the average, just to make sure we've got the record straight. But I think affordability is impacted, right? So prices have been climbing a lot, and a lot of that's due to increased money in the market and also the lower rates. So money's cheap, right? So you can stretch the budget, the payment's not as big, and I love cheap money. I'll take it, right? I refinanced my mortgage and my payment went down, I think like $500 when I refinanced from a 4.25 to a 3.25 rate. Now, again, I didn't get the best rate. Rates went down a little bit, but I saved an entire percentage rate on my mortgage, so I got an entire percentage rate off my mortgage. So I had an opportunity and I took advantage of it. Now, did some people get a little bit better mortgage rate than me? Yes. But I have a great mortgage rate. And if I'm going to compare with right now, I'm not going to be complaining. So I think, again, that same mindset when you're thinking about buying into the housing market or the stock market is, I have an opportunity here. It might get a little better, but we don't know. So I'm going to take advantage of it while I can. Again, that's just the mindset that I have. So we've got historical rates. If we look at historical rates, I just mentioned that the rates are typically and historically in that 7% range. Again, they've trended down. So if we're looking at this graph, you'll see they've certainly trended down over the years. Are we going to see 17% interest rates again? I certainly hope not, especially with where prices are at, right? It'd be completely unaffordable. We're going to have a cash-only market at that point, right? Or people are going to be lending money on the side to make it so that people can buy houses. It's just, that's the reality. That's a huge interest rate. But they have trended down. But again, they've danced in that 7% range, even as of the last 5 to 10 years. So again, they're starting to trend up. But historically, during recessions, you have interest rates going up, right? It's slowing the economy down. You're seeing the housing market we're starting to see higher interest rates, slower housing market. We're seeing a slower stock market. And again, the government's trying to do this right now to slow things down. But what happens after a recession? Mortgage rates go down historically. And when mortgage rates go down historically, what happens to the housing market? Things take off, right? Money becomes more affordable again. People have more confidence, less fear, and they start spending money again. And we saw this most recently, I guess we could say during COVID, but really that was more in the stock market. The housing market in our area, Seattle area, had very little of an effect, right? People were scared for like 2 weeks, but nobody was even selling their houses, right? So unless you had your house on the market and you thought the world was going to come to an end, you didn't really miss out or lose any money from where the market was, right? But the market did take off after that as interest rates went down, and we've seen an epic jump in housing prices. And again, that was the most recent, right, big drop in stock market values. We saw a brief pause in the housing market, skyrocketed. But 2018 to 19, we saw this in the housing market as well. We saw interest rates rising up. We got into the low fives. We're even higher than they were then. But we saw interest rates climbing up. We saw fear, some of the same types of, I'd say, symptoms of the interest rates increasing. Again, they're a little bit bigger now. We had 8 months in a row where we saw that median sales price go backwards. And the market corrected, I think it was about 15% if I remember correctly, a little bit more than that over that span, which is definitely more than what you'd normally see. But then within the year, right, we saw that, and then within the year, by the spring, prices were about the same. So what's happening right now? Okay, that's what happened then. What's happening right now? Well, over the last 7 days, we've seen more new listings coming on the market than we have solds. And we've been seeing this over the last month and a half. And historically in the springtime, that's what we're seeing. So I'm seeing over the last week in King and Snohomish County, 1,100 listings, just over that. I'm seeing 900 solds, 899, right? I'm seeing 848 pending listings, which is kind of what's happening right now, right? Solds are what's happened in the past. Pendings are actively happening. So I'm always looking at how many new listings, how many pendings. And I'm seeing 797 price reductions, okay? So houses are selling, but people are dropping their prices a little bit. Because what happens is people start to price in that escalation because they saw what their neighbors sold for, and then they start to see, well, it's not selling for that, right? And we need to find what people are willing to pay. So we're seeing price reductions because, well, people don't want to pay that same price they were even paying 2-3 months ago. And I have an example here. Recently, a client offered on a house in Linwood. This house was listed for, I think, $1.129 originally. I think the neighbors sold for that same price or really close to it. They had to drop their price to $1 million. Nobody wanted to buy it. They dropped their price to $900 and they had 2 offers. And my client was one of them. And they actually offered over asking price to get this house. We were the best offer, should have got it. Seller goes, I'm a little nervous. I don't want to sell it for that anymore, actually. So they raised their price again. It was a little bit of a bummer for them, to be really honest. But that house, neighbor's house, sold for more than $225,000 than theirs. And in the course of 2-3 months, a bigger house is going to be selling for significantly less than that smaller house, right? That other house that sold for more, 400 square feet less. So I think there's already really big deals to be had. And I think, again, that's where I'm talking about opportunity. I don't know how much this market's going to correct and where it's going to end up. Obviously, interest rates do play a big part in affordability. There are a lot of people still out there. They're just either not able to buy right now because of the rates or they're afraid. There's those two. But we still have a bunch of people buying houses too. So demand is certainly down, but there's still plenty of people buying houses, right? And the difference between new listings and pendings in the last week doesn't even seem that different than normal years, okay? It doesn't. It's normal this time of year we see more listings coming on the market. And I'm not trying to paint a rosy picture for all of you who love to say that. That's just the facts, right? We're looking at data right now. So what happens during a recession? Normally during a recession, okay? The Case-Shiller Index, and I mentioned this in my other video that I talked about earlier, the 4 reasons I don't think we're gonna see that massive correction, right? And typically during a recession, the housing market goes flat. If we look back to the 60s and I have a graph here I'll show you where we've got the recessions mapped out on a graph with the Case-Shiller Index for the whole US. And Seattle's market's a little bit different and has actually fared better in some cases. But if we're looking at this map, we're seeing a flat housing market, except for that massive drop that we talked about. So if we're looking at that, the housing market's more flat. Again, there's going to be those bumps, but if we're looking at the full picture, it doesn't take that long in general, aside from that one case that we're looking at here over the last 60 years, for the housing market to jump back to where it was and to continue on the upward trajectory. And again, a lot of it's tied to those interest rates, which right now are high. But again, historically, interest rates are going to go up when there's a recession and when they want to stimulate the economy again, right? That's when those rates are going to drop and we're going to see more of the growth again in the market. So this is my theme here. Can I commit? Okay. I think this is one of those things you have to think about as a buyer. So if you're thinking, well, is this the time to take advantage, right? Is this the time? Well, I already mentioned that we're already seeing, in general, houses starting to sit on the market a little bit longer, people dropping their list prices. And if we look at some of the data, and we'll have some of that new data here in a few weeks for the whole month of June. Again, I'm just looking at a little snapshot. We're most likely going to see houses selling a lot closer to the asking price. But again, we're still seeing houses selling over asking price. But there are also houses that are sitting on the market and reducing their price. So we're going to see a little bit more of that balanced out. But I think this idea of commitment is huge, because if you think, hey, I'm going to buy a house for a year or two and then just like maybe I'm going to move back to California, or I'm going to move to Boise or Texas, maybe this isn't the right time for you to buy. I think you have to have a little bit more of a long-term horizon in your mind. If you look at 2007, so we're going to go back to the worst case here. 2007, Seattle's prices were at an all-time high. If we're looking at the residential median sales price, July 2007, $498. July 2014 is when we saw median sales prices go above that again. Okay, so there was a period where it was going down and or very close to up until July 2014. So 7 years up to 525. Okay, so there was definitely, again, this is like the worst situation we can think of on record. And at this point, May 2022, right, so this is last month's 996, almost 997 if we round up. So over 200% up in 15 years, right? And that's with that 7 years of down, and essentially if we were to look at that whole period and call it neutral period, that's significant growth. But over that 15-year period, 200% up, all right? But again, you have to hold on to it. So I think if you're looking, okay, well, you're currently not buying at the peak, or you are close to it, but again, you have to think like, even if it's the worst case scenario, you have to have a longer horizon. The average person's living in their house 7 to 10 years. So the average person in that situation probably came out ahead, especially if they held on to it. I think the other option, a lot of people rented out their houses. So they were able to, they bought their house and then they saw the market drop and they did what we were talking about in the stock markets, they bought again. So maybe they were able to buy their dream house, that next house, at a better price, right? A little bit more maybe than what they paid for their other one, but they were able to buy that next house with a higher interest rate, which they had to do, and they were able to get that nicer house, and then they were able to refinance that house when rates came down, and then they were able to sell this other house that they rented out for a short period of time and get that one gone. So they were able to make that upgrade without paying a whole bunch more, which you would do or would have had to do in the last year. So again, I think there's opportunities for that move-up buyer to take advantage of the market, but you have to have a little bit more creativity in that longer perspective. Now, do I think that that's what's going to happen? Do I think we're going to see this massive drop? And I already hinted at it multiple times. I don't think it's going to be that catastrophic drop. I'm thinking more of the short-term, 6 months to 12 months type of a drop. And that's what we saw in 2018 to 19. I think a lot of other people would agree with me that I listen to and follow. But again, there are people that are going to disagree and say we're going to see the worst drop ever. Again, we don't have a crystal ball. But let's just say we're not going to have the worst drop in history, again, because this is not the housing market's fault, right? It's not the housing market's fault that we're correcting right now. But a few thoughts here as we wrap this up. Why do I not think this is going to be that epic crash, and I think it's going to be more brief? Well, if we look at some of the people getting into the housing market right now, the millennials and the Gen Zs, we have the largest demographic of home buyers getting into the market, right? In jobs, high-paying jobs, ready to go, buy a house. We also have a whole bunch of millennials that are getting into that older category and certainly thinking about buying a house, and we're going to outnumber the baby boomers, okay? That's crazy to think about, right? Previous largest generation, it's about to get outnumbered. We also are starting to see the highest levels of new construction here recently, but we haven't been making enough houses. We haven't been building enough houses. So if we look at some of the data here in the US over the last decade, all right? So we're looking back, and this graph's going to show us info back to the 30s. We've pretty much built the same amount of houses we were building back in the 30s over the last decade. And if you look back at some of these other numbers, we were building 21, 20, 25, 25, 26, 27 million house starts. In the last decade, we've had 5.8. And I don't want to get into why. I can certainly explain that. But I think we haven't built enough houses, which is why we're having this inventory shortage. We have a lot of people that are coming of age and wanting to buy houses. It's not like people stopped having kids and moving to the area. And again, we're talking about Seattle, right? This is national data, but Seattle's even hotter. And we've had our own issues with new construction and building. There's just not enough houses for everybody, and it doesn't just get solved overnight. If you think about the car shortages right now, it's been a year plus now where we've been really desperate for cars, maybe even a little longer. And it's not like they're just going to magically have enough cars for everybody all of a sudden. You still can't even, in some cases, order them, right? It's hard. You got to just like hope that they get one in and that you're the one that's going to get it. And then you have to pay a premium for it. So we're still years behind that in the new construction world. So do I think right now people are afraid? Yes, I do. Do I think, and am I seeing the housing market going down and shifting? Certainly. Certainly. Interest rates are up. There's a lot of fear about the stock market and how that impacts the housing market. I think we're in this place where people are sitting on the sidelines for multiple reasons. But what happens when those reasons change? Well, I do know that the rental market's absolutely crazy and there aren't enough rentals right now because everybody's trying to rent, right? So when interest rates go down a little bit, the fear is lessened. We still don't have enough houses for everybody, and we still have too many people for all those houses. So what I think is going to happen is we'll see a fairly quick adjustment, and this is no different than what we saw, I think, in 2018 to 19. Again, there was a temporary lull in the market. It was fairly short-lived, and then we saw things pick back up again. So that's where I think we're headed. Do I think there's going to be opportunities here in the next 6 to 12 months? Yes, I do. And again, I don't know how long it's going to last, and nobody really does. But I think if you have the opportunity to take advantage of a less competitive market where you're not paying 15, 20% over the asking price, and you have the opportunity to buy something, maybe make that upgrade purchase with a little bit higher interest rate, you'll also have that opportunity to get a better interest rate. As we're seeing, interest rates have historically trended down. And then you'll have been able to purchase that at a discount. And there are discounts out there already, right? It's not like we're waiting for those. They're already here, and we don't know how long they're going to last. So again, if you have that chance, this is when I would start to take advantage of those opportunities. So if you're not in the market now, this would be the time to maybe start getting into the market and just waiting in. You've got time, and historically this summer and into the fall is the better time to buy as far as amount of selection and inventory. And also when there's a little less competition in the market. So this is that window that's coming up, and I think it'll be even better than it normally is. Thanks so much for watching this video as we walked through the shifting Seattle housing market. I hope you learned something here as we were going through. And again, I love dialoguing with comments, so if you have other thoughts or other perspectives, I'm happy to dialogue with those, or it's actually kind of fun to see some of you dialogue as well in the comments. If you have questions about your situation though, or you want to talk a little bit more specifically, feel free to reach out, and I'm happy to be a resource.